Hey guys, it's Jessica Stone at Stansberry Research, and I've got James Early of Stansberry China here for a discussion on who he thinks globally, from a stock perspective, will benefit the most from a Biden-Harris administration. James, thanks for joining us. First of all, we have some idea of the kind of government that Biden-Harris want to run, and it is a typical Democratic approach with more taxes of the rich, more benefits. How do you think that plays out in terms of global stock offerings?
No doubt we're going to see more infrastructure spending. We're going to see a higher corporate tax rate. Trump brought it from 35 to 21. It's going to probably go back up to 28 with Biden, who's about 7.5% ahead in the polls right now. I don't think internationally we're going to see that much difference. I mean, I think we're going to see a similar stance on China, but I like infrastructure more. Brookfield Infrastructure Partners, Atlantica, it's like an environmental infrastructure company, maybe like a pipeline like Williams. I think in either case, investors are safer playing infrastructure, because even if Trump wants to spend $1 trillion and Biden wants to spend $2 trillion, we're still going to get infrastructure. Healthcare is a little bit more risky, but healthcare might take a hit under Biden or not if he enriches Obamacare. Then we see Cigna, we see United Health, those companies take a bump.
I want to pick up on what you said about infrastructure, because this is a conversation going on in Washington right now. The idea that Kamala Harris, who's on the Senate Budget Committee, already could come into office with the votes for an infrastructure package, essentially using that as a vehicle for immediate stimulus under a Biden-Harris administration. This is something we've begun to hear a little bit more buzz about, and certainly lobbyists that I talk to say that they're hearing the same thing. So infrastructure under Biden-Harris would likely be a larger package, go to the municipalities instead of private sector components. You talked about a couple of stocks you think could be impacted. Are any suppliers likely to be impacted even under the sort of pandemic age that we're at?
I mean, they could. I mean, supplier, obviously, we need more supply, but that's a riskier play in my view. I mean, that's more connected to the global demand. So I would stay with the actual implementers, I guess, for lack of a better abstract word. One thing, speaking of Kamala Harris, I would avoid anything related to for-profit education. She hates that sector. She has hated that sector for a while. So I would get out of that.
Obviously, a lot of the economic recovery in this country and even around the world to some extent is based on monetary policy. Your thoughts of what would happen under monetary policy, even though Biden-Harris don't have control over that, they're likely to really focus on stimulus to get us out of this malaise.
Yeah, they're likely to spend more than Trump, and Trump has spent a lot already. We're spending so much more money, and we could spend so much more under Biden-Harris that maybe we do see dollar weakness. But then again, I see counter pressure from that, because that's going to make the U.S. a better exporter, and all these export-driven economies aren't going to like that. So I think that's going to put a natural lid on, or natural floor, I should say, on dollar weakness. So I'd buy gold, but I wouldn't go crazy.
What about the impacts on U.S.-China relations under a Biden-Harris administration? Obviously, we're seeing the tensions mount going into the election, but there are ways to invest in a trend if you see us going more into green energy, for example, if you see us tightening up rare earth mining in China. There are some sort of global stock and supply and even commodities plays.
Yeah, I think ironically, despite all this talk about, other policies, we're going to be driven by two C's, China and COVID. So how either president responds to those two issues is going to be the big swing factor. I think in terms of China, we're going to see more stability. We're not going to see so much difference in terms of the verbiage. Trump has been a lot of bark, but relatively less bite. I think we're going to see more of a match between the bite and the bark with Biden on China. We were already deglobalizing anyway. The world was deglobalizing anyway before this presidential election became an issue. So we're just going to see more of that. I don't think there's going to be a big difference, but that doesn't mean you can't play that trend and shouldn't play that trend as an investor. I mean, it certainly affects, EV supply, but it affects healthcare too in terms of the onshoring. I mean, look at the Kodak disaster, right? We're trying to bring our supply into the U.S. That's going to bump pharmaceutical prices up maybe 20, 30% if the active pharmaceutical ingredient API cost goes up more. In terms of investing, though, I think that's a risky play. I think most of these things, and here's the danger, Jessica, of investing based on this, is we can sit here and look and say, here's what's going to happen, but so too can everybody else. So I still favor long-term trend investing, meaning like,
Mm-hmm.
I like EV, I like AV because I like it as a 5 and a 10-year play, not because it's going to get a presidential election bump. Same thing with certain infrastructure. Even like in the US, certain water systems, municipal water systems, are using pipes that are 200 years old. That is ridiculous. Okay, that is a long-term good reason to like water supply companies. That's not really connected to the election per se. So if I'm an investor, I'm looking at stuff that might play well with the election, but also has a long-term catalyst as well.
All right, we'll leave it there. Thanks so much, James Early, for joining us. And if you want to be connected to more of what James Early has to say, please subscribe to our YouTube channel. You can also find us on Facebook, Instagram, LinkedIn, and Twitter. Thanks so much for watching. That's all for now.